Meet Daniel. Daniel is 34. He works in logistics management for a mid-sized company in Columbus, Ohio. He makes $68,000 a year. He got a promotion 18 months ago. A real one. Title change, $11,000 raise, the whole thing. His coworkers congratulated him. His mom cried a little. And 18 months later, Daniel has less money in his checking account than he did before the promotion. Not because he bought a boat, not because he developed a gambling problem, not because he did anything reckless or stupid or irresponsible, because the system absorbed every dollar before he ever had a chance to decide what to do with it. And here's the part that should make you angry. Daniel did everything the right way. He has a budget. He uses a budgeting app. He doesn't buy things he can't technically afford. He's not carrying credit card balances from vacations. He reads personal finance content. He knows what a Roth IRA is. He just can't seem to get ahead, no matter how carefully he manages what he has. And he has quietly started to wonder if something is wrong with him. Nothing is wrong with him. But something is very wrong with the system he's operating inside of. And today I'm going to show you exactly what that system looks like, who built it, how it works, and why it was never designed to let you get ahead, no matter how disciplined you are. My name is Peak, and I spend way too much time thinking about the invisible architecture of financial systems that are specifically designed to extract money from people who are trying to do the right thing. If you've ever done everything right and still felt like you're running in place, if you've ever gotten a raise and wondered where it went, if you've ever followed the rules and still felt financially fragile, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because what I'm about to show you isn't a personal finance pep talk. It's not a list of budgeting tips. It's a system map. A look at the actual machinery underneath the financial decisions you make every single day. And once you see it, you cannot unsee it. Let's start with something that sounds obvious, but isn't. The financial system in America was not designed to help you build wealth. It was designed to extract wealth from you as efficiently as possible while leaving you just comfortable enough not to revolt. That sounds extreme, I know. But follow the money and tell me where I'm wrong. Every major financial institution in the country, every bank, every credit card company, every auto lender, every mortgage servicer, every insurance company, every subscription platform, every retail financing operation makes money specifically when you spend money you don't have or pay to access money you do have. Banks don't profit when you borrow it. They profit when you borrow it. Credit card companies don't profit when you pay your balance. They profit when you carry it. Auto lenders don't profit when you pay cash. They profit from the 72-month loan at 7.9%. Every single incentive in the system points in one direction. Keep the consumer spending. Keep the consumer borrowing. Keep the consumer just solvent enough to keep spending and borrowing. And they are extraordinarily good at it. Here's the first mechanism, and it operates so quietly that most people never notice it. I call it the automatic absorption system. When Daniel got his $11,000 raise, here's what happened before he made a single conscious decision. First, taxes. His marginal tax rate went up. That $11,000 in additional income got taxed at a higher rate than his existing salary because of how progressive tax brackets work. Federal income tax, state income tax, payroll taxes. By the time that raise cleared the withholding filters, $11,000 became roughly $7,200 in actual take-home pay. $7,200. That's what Daniel actually received from his promotion. Already, we're 35% smaller than the number that made his mom cry. But we're just getting started. Because Daniel got a raise, Daniel felt like Daniel could afford a slightly nicer apartment when his lease came up 2 months later. Not a dramatic upgrade, just one tier up. He went from $1,050 a month to $1,280 a month, a $230 difference. Seemed reasonable for someone who just got promoted. That's $2,760 per year, gone. Because Daniel got promoted, Daniel's commute changed slightly. New role, more client meetings, slightly different schedule. He started paying for parking downtown twice a week, $40 a week. Seemed small. That's $2,080 per year, gone. Because Daniel was working harder in his new role and getting home later, he started ordering food delivery more. Not every night. 3-4 times a week instead of 1. An extra $60 a week in delivery fees and convenience markups. That's $3,120 per year, gone. Let's add it up. $7,200 in actual post-tax raise, minus $2,760 for the apartment upgrade, minus $2,080 for parking, minus $3,120 for food delivery. Daniel's $11,000 raise left him $760 ahead for the year. $63 a month. Not because Daniel is reckless. Not because Daniel failed at budgeting. Because the system is specifically designed to expand costs in proportion to income so that every raise you get gets absorbed before you can redirect it toward building wealth. This is not an accident. This is a feature. Now let's talk about the second mechanism, because this one is more insidious. I call it the access tax. Here's something most people don't think about. In America, being poor or financially stretched is dramatically more expensive than being financially stable. And this creates a self-reinforcing trap that the system profits from at every level. Let me give you specific examples because the numbers are clarifying. Car insurance. A 2022 study from the Consumer Federation of America found that people with lower credit scores pay significantly more for identical car insurance coverage than people with higher scores. Same car, same driving record, same coverage. More expensive because their credit score is lower. And why is their credit score lower? Often because they had an emergency, missed a payment, used more of their available credit during a hard month. The system penalizes you financially for having been in financial difficulty. Bank fees. If you have enough money in your checking account, your bank charges you nothing. If your balance drops too low, your bank charges you a monthly maintenance fee, sometimes $12 to $15 for the privilege of being a customer with less money. The people who can least afford fees are the ones paying them. Payday and installment loans. The people who can't get approved for a 7% personal loan because their credit isn't perfect have access to payday lenders charging effective annual interest rates of 300 to 400%. The financial system doesn't just fail to help the financially vulnerable, it actively extracts more from them. Rent versus mortgage. Someone who can't afford a down payment on a house pays $1,400 a month in rent and builds zero equity. Someone who can afford a down payment pays $1,400 a month in mortgage and builds equity every single month. Same payment. Completely different financial outcome. The access tax is the cost you pay for not already having money, and it compounds every year. Daniel pays this tax too, by the way. Not at the extreme end, but he pays it. He financed his car at 7.4% because his credit score was 690 when he bought it. Good, but not excellent. Someone with a 760 score at the same dealership for the same car paid 4.1%. Over a 60-month loan, Daniel paid roughly $1,800 more for the exact same vehicle. He didn't make a bad decision. He just got taxed for not being wealthy enough yet. Now, here's the third mechanism, and this is the one I need you to really sit with. I call it the engineered desire loop. The financial extraction system doesn't just wait for you to spend money. It manufactures the desire to spend money and then provides the frictionless mechanism to do it before your rational brain catches up. Let's talk about what happened to retail credit over the last 20 years. In 2000, if you wanted to buy a $1,200 television, you saved up $1,200 and you bought it, or you didn't buy it. The friction of saving created a natural filter. If you couldn't save $1,200, you probably couldn't afford it. Simple. Today, that same television purchase comes with a prompt at checkout. 24 months, zero interest financing. Just $50 a month. The retailer makes a deal with a financial company to absorb the financing costs in exchange for capturing your purchase in the moment before you leave the store. The $1,200 TV becomes a decision about whether you can afford $50 a month, which feels very different. And the answer is almost always yes. But here's what actually happens. That $50 a month becomes part of your fixed cost floor. It stacks with the other $50 a month items, and the $30 a month items, and the $89 a month items, until your fixed costs have expanded to consume your income. And then something breaks, or something unexpected happens, and the whole structure becomes fragile. Buy now, pay later. Services have made this dramatically worse. Klarna, Affirm, Afterpay. These companies exist for one reason: to remove the friction between desire and purchase, to collapse the distance between wanting something and having it so that your rational financial brain doesn't have time to intervene. A 2023 report from the Consumer Financial Protection Bureau found that buy now, pay later users were significantly more likely to carry high credit card balances, more likely to have overdrafted their account recently, and more likely to be financially distressed than non-users at every income level, including people making solid middle-class incomes. The product isn't the television. The product isn't the shoes. The product is your future cash flow, and they are extraordinarily sophisticated at capturing it. Here's the fourth mechanism, and this one operates at a scale most people never think about. I call it the complexity shield. The financial system in America is deliberately, structurally, intentionally complex. Not because complexity serves consumers. It doesn't. It serves the institutions. Think about what the average American is expected to understand to just not lose money. Tax brackets and marginal rates, 401k contribution limits and matching structures, the difference between a traditional and Roth account, how credit scores are calculated and what actually moves them, how mortgage points work and when they make sense, how insurance deductibles and out-of-pocket maximums interact, what index funds are and why expense ratios matter, how compound interest works against you in debt and for you in investments. This is an enormous amount of technical knowledge, and none of it is taught in school. None of it is explained in plain language by the institutions that profit from your not understanding it. The complexity is the moat. A bank earns more revenue from a customer who doesn't understand how credit card interest compounds than from a customer who does. An insurance company profits more from customers who don't read their policy than from customers who do. A 401k provider earns more in fees from customers who pick the wrong fund than from customers who pick the right one. The complexity isn't a bug, it's a revenue model. And here's what really gets me about this. When people can't navigate the complexity and end up in financial trouble, the narrative is always that they made bad personal decisions. They were irresponsible. They didn't educate themselves. They should have known better. The system creates complexity that requires professional expertise to navigate. It withholds that expertise from the people who most need it. It profits from the resulting confusion. And then it blames the consumer. That is not a personal finance failure. That is a designed outcome. Now, I want to talk about the fifth mechanism because this one hits different. I call it the social proof spending engine. Humans are social creatures. We calibrate our sense of normal against the people around us. What's a normal car? What's a normal vacation? What's a normal apartment? We don't answer these questions in isolation. We answer them based on what we see people like us doing. And for the last 15 years, what we see people like us doing has been algorithmically curated to show us the most aspirational version of our peer group. Instagram, TikTok, LinkedIn. These platforms don't show you an accurate cross-section of how your peers are living. They show you the filtered, highlighted, highest spend version of how your peers are presenting their lives. And this is not neutral. It is not accidental. The platforms profit from engagement. Aspirational content drives engagement. So the algorithm surfaces aspirational content. The restaurant, the vacation, the new car, the home renovation. And your brain, which is wired to calibrate normal against your social environment, looks at this curated highlight reel and recalibrates upward. What's a normal vacation becomes more expensive. What's a normal car becomes more expensive. What you deserve because you work hard and everyone else seems to have it becomes more expensive. And then you spend. And the platforms win. And the retailers win. And the lenders win. And you wonder why you can't get ahead. There's a 2022 study from the National Bureau of Economic Research that found household debt increased measurably in zip codes where exposure to high-income lifestyle content on social media was higher. Not because people in those zip codes earned more, because their sense of normal got recalibrated upward by what they were seeing online, and they spent accordingly. They didn't make bad decisions. They made decisions that were entirely rational given the environment the platform engineered for them, an environment that was specifically designed to make aspirational spending feel normal. So what do you actually do with all of this? Because I'm not going to leave you with just a map of the trap without talking about the exit. And I want to be clear. The answer is not to rage against the system, or go off grid, or swear off all consumption. That's not realistic, and it's not the point. The point is to understand the mechanisms so you can see them operating in real time. Because you can't defend against something you can't see. The first thing you do is audit the automatic absorption. Every time you get a raise, every time your income increases, stop before the system absorbs it. Sit down with a single question. Where is this money going to go before I decide where it goes? Name every automatic cost expansion that's coming. The slightly nicer apartment you'll be tempted to move into. The upgrade you've been delaying that now feels justified. The extra spending that will come from being busier and more tired in a more demanding role. Name them in advance and consciously decide. Not react. Decide. The second thing is to calculate your own access tax. Sit down and actually add up what you're paying for not being wealthy enough yet. The higher insurance rates from a credit score that isn't perfect. The financing costs on things you had to finance instead of buy outright. The fees you're paying on accounts that charge fees. The rent premium you're paying instead of building equity. This number is probably larger than you think, and seeing it clearly creates the motivation to eliminate it systematically. Third, add friction back to spending on purpose. The system is designed to remove friction. Your job is to restore it. Don't save your card to retail sites. Use a separate account for discretionary spending with a fixed weekly transfer. Put a 48-hour rule on any unplanned purchase over a specific threshold. These aren't restrictions. They're circuit breakers that give your rational brain time to catch up to your impulse brain before the transaction clears. Fourth, learn the complexity on purpose. I know that sounds exhausting, but you only need to understand the pieces that affect your specific situation. You don't need to become a financial advisor. You need to understand your tax bracket and how your 401k interacts with it. You need to understand how your credit score is calculated and what moves it. You need to understand what your investment accounts are actually invested in and what it costs you. 1 hour a week. That's it. The people who profit from your confusion are counting on the complexity, feeling overwhelming enough that you never start. And fifth, and this is the one that matters most, recalibrate your social proof inputs on purpose. You cannot opt out of having a sense of normal, but you can choose what shapes it. Seek out content, communities, and conversations where the flex is net worth and investment returns, not visible luxury. Surround yourself, even digitally, with people whose version of winning involves building invisible wealth. Your sense of normal will adjust, and so will your spending. Here's the thing about Daniel. Daniel is not bad with money. Daniel is a careful, thoughtful person who is operating inside a system that was built by very smart, very well-funded institutions whose entire business model depends on absorbing every raise, charging more for access, manufacturing desire, hiding complexity, and making his spending feel normal and inevitable. And as long as Daniel thinks the problem is him, he'll keep trying to solve it with discipline and budgeting apps. He'll keep optimizing inside the trap instead of understanding the trap. But if Daniel understands the system, everything changes. Not because the system disappears. It doesn't. But because you can't extract money from someone who can see the mechanism. You can't trigger the automatic absorption if someone named it in advance. You can't manufacture desire in someone who knows that's what's happening. You can't hide complexity from someone who decided to learn the relevant pieces. The system is designed for people who don't know it exists. Now you know. The question is what you're going to do about it. If this video changed how you see your finances, make sure to hit that subscribe button. I make content about the systems, the traps, and the psychology designed to keep you stuck. And if you want to share this with someone who's been blaming themselves for something that was never their fault, this is the video. I'll see you in the next one.